Like many of you, I'm an engineer, and I did my undergrad in computer engineering. I actually never had looked at the stock market or stocks or went to business school. And in 1994, quite by accident, I read a book, which is the one you can see on the slide. It's by Roger Lowenstein, and it's a biography on Buffett, Buffett, The Making of an American Capitalist. And I was very lucky because just at that time, the first couple of biographies on Warren Buffett had come out. And when I read the book, it led to a very significant epiphany, which eventually led me immediately, actually almost immediately, to start spending something like about 20 hours a week on investment research. And then about 5 years after that, to actually do a 180 and start an investment fund. And the thing that I found very compelling about the book was that Warren has this saying that I'm a better businessman because I'm an investor, and I'm a better investor because I'm a businessman. The interplay between running a business and managing an investment portfolio. And when I read Buffett's biography, it dawned on me that the tools you use when you're making investments are almost identical to the tools you use when you're running a business. So, for example, when I was at that time running an IT services company, and I would probably spend maybe 2 or 3% of my time on strategy and direction, figuring out kind of which areas we would focus on and those sorts of things. And then 97% of the time was the heavy lifting, the blocking, tackling, and making that strategy happen. And initially, when I was doing this for the first few years, it was very exciting because you'd basically have a hypothesis, and then you'd go out and try to execute on the hypothesis, and then you'd have real-world results to look at. Well, when I read Buffett's biography, what dawned on me is that 3% of time that I was spending for someone like Warren Buffett was like 80% of time. Because what he was able to do is apply the same analytics towards understanding which businesses and industries and such were great investments. And so the parts of the brain that you use in figuring out business strategy and direction are pretty much almost identical to the same parts that you would use as an investor. And I always found that the 3% of time was a lot more exciting personally than the 97%. I mean, I enjoyed the 97%, but nothing like the 3%. And so the idea of blowing up the 3% to 80% by letting someone else, in effect, run the business, and you figure out where you want to allocate capital was very exciting for me. And so that's what led me to, I had sold a small few assets in the business. For the first time, I had about $1 million, which I didn't have any need for. And so I decided to take the $1 million and put it into equity investments as an experiment to see how far I could take Buffett's model and applying those same analytics that I was using and try to blow it up. So basically, I immediately got to spend about 20 hours a week on what was normally would have been just a week or two in a year, and then a lot of time just executing. And so if you can go to the next slide. And so one of the first investments I made, this was in '95, and it actually shows the interplay between the real world, if you can call it that, and the investing world. And so I was running this IT services company. There was this company in India which was called Satyam Computer Services. And Satyam was trying to expand its business in the United States. And their sales team had visited me in Chicago. They wanted to see if we could do some kind of relationship. And we never did any business, but I liked them a lot. I liked the people. And I liked the way they were going about their business and how they were positioning themselves. So then I decided to study Satyam as a stock because it was publicly traded in India at the time. And when I studied it, it was actually, I was a novice investor at the time, but it blew my mind because the market cap of Satyam was less than what you might have valued their real estate in Hyderabad. So the stock was trading below what would be just liquidation value on real estate. And this was a IT services company that was growing something like 70% a year, very high margins. And I really couldn't see the end of that runway. That runway was really big. And of course, investing in India was a little complicated. But I did it, but I wasn't confident enough because we didn't have electronic trading. There were these flimsy stock certificates you got. And I didn't fully trust the Indian government on the ability to actually get the money back in dollars, even though they said the rules would allow that. So anyway, I made a $10,000 investment in Satyam. I bought 3 or 4 different stocks in India, and Satyam was one of them. And I decided this is one of those investments where you just buy and forget about, never look at it again and just let it run for 10 years. And I bought it at 40 rupees a share, and about 5 years later, and this is, of course, we had the whole dot-com boom in getting going, and Satyam had started to spun off 1 or 2 of these dot-coms. The stock had gone from 40 rupees to in February or March of 2000, 7,000 rupees. So it had gone up like 130 or 140 times. And, currency had moved against me, but still, even with the currency movement, it was more than 100x. And so I decided to, kind of stop drinking the Kool-Aid and do an analysis of the financials at that time, because I basically never looked at it after that. And when I did the analysis, it was trading at a north of 100 times earnings. And they had all these, dot-coms, which I didn't think, I couldn't figure out what they were worth. And I said, I think we've got more than $1 million in Satyam stock from the 10,000, and I think we're going to take our money off the table. The other thing I was concerned with is I didn't know whether they would allow me to pull it back from India, because the government said you could come in, give us your foreign exchange, and when you sell it, no long-term gains tax, and you can pull the whole thing back. And I didn't trust that, so I said, let's test that. And so I sold, and I had these certificates, I didn't even know they were authentic. So it sold, and the money got into my bank in India, and then I said, wire it to my bank in the US, and the next day it was in the US. Okay, so the whole thing actually worked exactly like they said it was, and I said, well, I should have trusted them a little bit more. So that was Satyam. We can go to the next slide. And so there was this other company in the mid-90s, PeopleSoft. And one of the things where, the interplay between investing and running a business, so we were basically doing system integration. So we would, for example, we had a team which was had expertise in Sybase, in Oracle, all these different databases. And what I started doing when I was looking at investing is I started looking at all the software companies, because that was an area I understood. And one of the companies I found which has a very high PE ratio was PeopleSoft. I think it was trading at like more than 50 times earnings. And PeopleSoft was like SAP, basically, where they needed system integrators to go in and implement the product. So I said, well, what I can do is I can't buy the stock because it's ridiculously priced, but I can do a backdoor. And the backdoor I did is I said, well, the market is mostly efficient. So if it's at 50 times earnings, the market expects tremendous growth. And so I said, and it looked to me like it would grow a lot. So I said, if we in my company, TransTech, set up a PeopleSoft practice, that would not be buying at 50 times earnings. I would just be hiring people. And then I'd have them build out of these different companies, and it'd be pretty spectacular margins because it was so new and growing. So I decided we would set up a PeopleSoft practice. And I still remember the economics were just incredible, because I hired this guy who was probably the most expensive guy we'd ever hired at that time. This was 96 or something. I think he was a PeopleSoft practice leader, and I think he cost us like $250,000 a year. And we didn't, when we hired him, we didn't know what we would do with him. But I just said, okay, I need to have some horsepower coming in so we can then figure out, because this guy knows what he's doing. I said, once he comes in, then we'll sit down and figure out what to do. So he comes into work the first day, and he says, by the way, are you looking for clients? I said, yeah, we're looking for clients. And he says, well, I've got these relationships, and there are 3 or 4 places, and I can go in with a team of 15 people. So I said, Paul, I don't have the 15 people. Do you know the people? He said, yeah, I know the people too. Okay, so he helps us hire these 15 buddies of his. And I don't think it was even a day that he was non-billable. So in 2 days, he's billing at multiples of the $250,000 paying him. And the team is going in at 50% margins after covering all expenses. And so when I looked at what happened with PeopleSoft, our actual cash out the door would kind of be like the Dell model, where you ship the PC and then you pay your suppliers later. I hadn't even paid the payroll on these people before we raised our first invoice. And the invoice was at a huge margin to what we were going to pay them. So when I actually calculated dollars invested in the PeopleSoft practice, I think it was a negative number. And in the end, a lot of the rest of our IT business was kind of declining because it was matured out and getting competitive. This was very high margin. And so that's an example of how I used the stock market to drive. I said, no, so this is cool. I'll just keep looking at companies that are 50, 60, 70, 100 times earnings, and then go build a practice. And because I know they're going to go up. And so that worked very well. So we go to the next slide. And then, there was, then we get to, from, we had Satyam and stuff, but from 95 to 99, I think I'd done like north of 70% a year on that $1 million we originally had. So things had gone really well. But then, in 99, and this is when Pabrai Funds had started, one of the first investments we made is I was seeing the big bubble in the internet, and it was, it was clear to me that the internet was transformational, but it was also, I was very skeptical of the pets.coms, if you will. So there was a side of me which said, yes, I can see how this will change people's lives, but I was kind of having a hard time of what kind of bet I can make, right, which would be a safe bet. And so then I find this company, which is headquartered not too far from here, Silicon Valley Bank. And these guys, it's a very well-run bank. It wasn't trading at a significant multiple to book, at just a modest premium to book. But what they did is every time they did deals with these venture-backed companies where they did asset-backed loans and all this stuff, they got warrants. So every company that they did a loan or leasing or different deals, they collected warrants in addition to the what they would get from the loan spreads. And so they were sitting on this basket of like 300 or 400 of their clients with these warrants, and many of these were pre-IPO, and there was no disclosure. There was no disclosure that they had made of, okay, look, here's a list of companies, here's the amount we own, and this and that. I just knew they are sitting on this massive amount of warrants. And so I said, well, if we buy the bank, and it was publicly traded, we're buying a well-run bank, and we have an automatic upside if these warrants come in. And I don't know whether they would come in or not, but I said, it's kind of heads I win, tails I don't lose much. You might have heard that before. And so we bought Silicon Valley Bank, and I think within about 6 months, we had a 4x on it. Because then they started reporting that, yeah, we had this huge amount of income because these companies went public, we sold, and it was dwarfing their interest spreads. And so then, we can just go to the next slide. And so now we come full circle where about a year ago, I set up a company called Dhando Holdings. And, so now it's been about 16 years that I've been, 80% time doing strategy, if you will, which is great. I'm getting paid for it. What a country. And, but I found that, the Pabrai Funds is somewhat limiting because I'm limited to public markets. I'd gotten into the technology company, so I didn't have a way to kind of go and do these kind of roll up your sleeves type things. And so I set up Dhando Holdings about 18 months ago, and we raised about 150 million, and we just bought an insurance company. And now this platform allows me to buy any kind of asset. I can buy private companies, public companies, real estate, anything I want. And so it allows a little wider playing field, if you will. And it allows, for the first time, we have insurance float, which I've heard is a good thing to have. And so now I have, which is the part I was always kind of interested in, is that, if you can control the business without really meddling or running the business, and if you can control the capital allocation of the business, that has some superiority to just being a passive private public equity investor. And so we have some elements of that in Dhando, and so we'll see how that plays out. So I just wanted to give a kind of a little backdrop on how an engineer goes from what I was doing to where I am now.